So a warm welcome everyone, and thank you for joining this Hardman Co Investor Forum. My name is Keith Hiscock and I'm the Chief Executive of Hardman Co. These forums give investors the chance to hear a company's investment case and to question the management. Our first presentation comes from Filta PLC. Filta provides cooking oil filtration, fire and drain management services to commercial kitchens across North America, the UK and Europe. And it combines a capital-light franchise model with some company-owned operations in the UK. COVID-19 obviously been an important part of the last year for everybody, but particularly for Filta, and it's both been a headwind and an opportunity. We're pleased today to have both the Chief Executive, Jason Sayers, and the CFO, Brian Hogan. And gentlemen, let me hand over to you, Jason.
Thanks, Keith. Hi, everybody. So this presentation's about introducing our business and the business model to you guys. It's not sort of our annual report. So we service commercial kitchens. The best thing about our business, we have regular repeat revenues to these customers. The downside, industry was hit pretty hard by COVID-19. At its low point, our UK and German markets were closed with a 90% reduction in revenue. However, what was in our control is how we reacted to it. We were still profitable, £1 million at the EBITDA, including 300 grand worth of bad debt provision for COVID, cash positive, showing really a robust model and robust team. There's actually two of us today, myself, CEO, and Brian Hogan, CFO. We're both based in Orlando, Florida. That's where we're here from. And I thought it was best to bring Brian on to talk about some of the financial side. Let me get to the company overview. So our company's Filta Environmental Kitchen Solutions. I started the business in the UK in the late 90s and came up with the idea for Filta Fry, cooking oil filtration and fryer management service. We expanded this through franchising in the UK and through selling master licenses in other countries. But the obvious market for our service was the States. So in 2003, I came out here with my business partner to grow the business here. So we now operate in the UK, North America, and Germany. We have two primary businesses, Filta Fry, that's the cooking oil filtration and fryer management service, where we take care of customers' fryers and cooking oil. And we have a grease and drain management business in the UK. We service well over 7,000 commercial kitchens every week, and we deliver the fryer management service through a network of 191 franchise owners who pay us monthly royalties and fees. We deliver our other kitchen services through 55 company-operated vans in the UK. Both provide us with very fixed repeat revenues for our business. The historical and future growth comes in a small part from new franchise sales, most importantly, our existing franchise owners expanding and our operational business expansion. We're well positioned now to take advantage of the sector recovery that we're seeing. So you see here, let me explain what we actually do as a graphic of a commercial kitchen. Everything we do is focused on high margin recurring revenue from that customer base. So Filta Fry, cooking oil filtration and fryer management service. So you see the fryers there. Problems in kitchens include high oil usage, poor quality food, hot oil accidents, slips, falls and burns, insurance claims. We solve all these issues. So we come in, so we pull up a van, wheel our machine out next to the fryer, suck the oil out the fryers, clean the fryers, pump the oil back in so they can reuse the oil again. And at the end of the life, we take the oil away and we sell it to make biodiesel. Usually we do this once, twice, 3 times a week, and the cost for the customer is normally recouped in oil savings, particularly now as the price of cooking oil has doubled in the US in the last year. Competition is principally in-house employees doing it themselves, and we have 468 trucks on the road performing this service in the US. Filta Fog's our next service, another one of our core services, fats, oil and grease management. So sinks, washing machines have a lot of waste oil going down the sewers. This leads to blocked drains for the kitchen and fatbergs in the main sewers, blocking the flow permanently. We install what's called GRUs, grease recovery units, under sinks that separate oil and water before it travels down the drains. We have the best performing equipment on the market. We sell these units in, we install them, we sign contracts to clean and maintain those units every month or quarter, providing us with ongoing, again, service revenue. We basically keep customers compliant with the ever-increasing water authority enforcement in the UK. Filta Seal is our next service. So those same customers have fridges. Those fridges have seals. Those seals wear out and need to be replaced every year or so. Typically, the place phones their refrigeration company. The refrigeration company comes in, measures the seal, goes away, orders it, comes back and fits it. Time consuming and expensive. In 2010, we bought the patent to some equipment that allows us to turn up on site, measure the seal, go in the van, manufacture the seal and fit it all in one visit. It's great service, so it's quicker and it saves the customers money. Again, it's all aimed to keep the customer compliant with health and safety regulations in the UK. Two other services, Filter Pump, the same customer base have pump stations for pumping waste off site. We install and we service these, again, keeping customers compliant. And Filter Vent, we introduced an automated vent cleaning system last year. Very early days for this, but we hope to roll it out in the coming years through our existing customer base. Again, keeping customers compliant with fire regulations. So let's have a quick look at our revenue model. How do these fit into our revenue model? We have 4 segments of revenue. We've got franchise development, fire management, equipment sales, and site services. Franchise development is the one-off fee we get from selling a franchise, primarily in North America. Then we have fire management. This is the repeat revenues we get from franchisees who perform the fire management service. So we provide a lot of support to our franchisees, sales, so we have a telesales team getting them work, tech recruitment, accounting, marketing, technology. So we generate fees for that in several ways. We have fixed royalty per machine. So we have a machine, it's our machine that they wheel into the restaurant. That machine, they pay us a royalty, $750 a month, every month. They have 2 machines, $1,500 a month. We take it by direct debit every single month out of their account. We then make margins on supplies and waste oil. So the blue piece on the left is the franchise model, primarily in the US. On the right, the green is the company operated model in the UK. So a bit like franchise development, equipment sales is one-off revenue from selling in the GRUs, the vent systems and pump stations. That's one-off revenue. Then our whole aim is to generate recurring revenue, which is site services. That's GRU servicing, seal replacement, vent servicing, pump servicing, and the Filter Shield COVID-19 spray service we introduced last year. All of that is the recurring revenue part of our business, and to grow it, our aim is to grow it year on year. Over 85% of our revenue is deemed recurring revenue each year. So let's have a look at where we are in the geographic markets. North America, we're based in Orlando, Florida. That's where we are now. We only have 14 staff members in the US supporting 146 franchisees who have 422 machines in the field. That's vans. Our network revenue, that's our franchisees revenue, in 2019 was $52 million. In Q1 last year, that grew 20% year on year before COVID hit. So our run rate was around $60 million a year, growing nicely. But then COVID hit. In Q2, there were fairly strong lockdowns in the US before it opened up in Q3, Q4 to a point where we were back to almost 70% of prior year revenue by the end of the year. Really depend on where you were in the States of how it's been opening up here. We supported our franchisees by lowering those fixed fees based on their revenue reduction. And we recently invested further in our sales team ready for the recovery. And you'll see some of the results of that in a minute. In the UK, we're based in Rugby. We have 36 franchise and 55 company operated vans there. In Q1 last year, we'd improved margins following the acquisition of Watt Bio, feeling pretty pleased with ourselves, then COVID hit. Q2, strong lockdowns, on and off ever since. We're just coming out of the last one, as you know there. But again, we invested in our sales team and focused on our relationships with key customers. Mainland Europe, we're focused in Germany, significant potential in Europe for us, but severe lockdowns in 2020, which continues now in Europe. So that stopped us in our tracks. We only have 3 staff members in Europe, so reduced overhead until the macro picture improves there. But we're focusing all our efforts and resource on the real growth opportunity now in the US and the UK. So let's have a quick look at North America post-COVID. So the economy only shrunk by about 3.5% last year in the US. The government, whether you agree with it or not, are injecting over $4 trillion into the economy here. You can feel it. It really has grown, and it really has, depending upon where you are in the States, as to what's happened. Here in Florida, we've been fully open since about September last year. No restrictions, you can go out. In different parts, California, New York, they're really starting to open up now. Vaccine programs are a success. They're doing up to 4 million people a day here in the US. And everything, the sector's recovering really quickly. And really, OECD, this was put together in March, had US growth of 6.5% this year. I've seen that go up and up since then to 9%. So things really are growing well in the States. Impact for us, many sites have now reopened, now increasing their service levels as well for us. When I mentioned we put resource into our sales team, so during COVID, so since last year, last January 2020, we serviced just under 6,000 restaurants or served commercial kitchens in the US. This January just gone, we serviced 4,500 of those 6,000. We added 935 sites during COVID, so we focused our sales team on growing that, and we still have 1,500 sites still to open of the sites we serviced before. They're the bigger ones. They're the stadiums, universities. So we service over 700 stadiums and universities in the US. Some of those have over 200 fryers per site. These are major customers for us. And we're really taking advantage by focusing all our efforts on the sales in the US and riding the wave. In the UK, you're more familiar with it there. The lockdowns have been a lot more severe and affected the economy worse, with almost 10% reduction in GDP last year. Government support's been exceptional. Household saving rates doubled during that period. Vaccine program a success. We're seeing it open more quickly now in Q2. I'm sure everyone's aware when your local pubs are opening. So a very similar chart here. In Jan-Feb last year, we serviced 4,400 customers in the UK. Of those in Jan, we serviced 2,000. We've added 750 sites. So we made decisions at the beginning of lockdown. Let's focus on a couple of things. Let's focus on cash, because no one knows how long the virus is going to last, whether it was a year, 2 years, 3 years. We also said, let's focus our efforts on particular types of customers. Let's go after fast food, because we thought they would stay open during COVID, and let's go after supermarkets. Those are really the customers we've been opening in the UK and the US since then. So really, we're expecting it probably back to full servicing by Q3 as the pubs really do reopen, as some of our major customers are those pub chains. Moving on to the next slide here, our market. Currently, we service over 10,000 restaurants, 2,000 supermarkets, hospitals in the US, sports stadiums, universities. So you can see in the US, our major customers, Compass, Sodexo, Aramark, Delaware North, we have exclusive contracts with those guys. That's the stadiums and universities I was talking about. Those really still have yet to come back. We're seeing them starting to open now. In the UK, our major chains we service, we have contracts with McDonald's, Costa Coffee, KFC, Asda's, Tesco's. Our biggest customer was Mitchell & Butlers, so they're now reopening. They've been pretty much shut since lockdown. Green King as well. So you can see we service some good names. One thing that's happened during lockdown, we've got really close to our customers, helping them come out of lockdown and obviously getting close and helping them solve problems they've got. Currently, we have less than 2% of the market, so we're really aggressively looking to expand right now. The growth strategy is to maximize existing customer relationships by upselling products and services, then add complementary services and products and gain new chain customers. Again, that's US and UK. I'm going to show you quickly some revenue trends. So we were growing nicely, 2018. We had just under 50% gross margin in the business. We bought What Bio right at the end of 2018. That's the biggest player in the UK in the grease recovery market. You can see our margins shrunk. So it took us a year really to get that business right. You can see in 2020 there, our revenues dropped due to COVID, but our margins increased. So we're looking to hold that margin as we grow revenues in the coming years. Cash and liquidity, let me just hand over to Brian to give you a quick overview of that.
Thanks, Jason. As Jason alluded to at the outset, this presentation is not tremendously focused on our results for 2020, but I'll just remind everybody that we did issue results back in April, and Hardman updated a note as well to correspond with that. I think the message that we'd like to deliver here is, looking back now 12 months or so from when COVID first affected the business, if you would have told us this is what the results would be for 2020 and this is what the outlook would look like, I think we would have signed up for it with all the uncertainty back in March of 2020. The focus has been always consistently on cash and liquidity in the business. We grew cash by 45% in the midst of the downturn. That was on a losing revenue. We lost about a third of our revenue, as Jason showed in the prior slide. So the ability to grow cash, we took advantage of all of the opportunities that were out there. We operate principally in North America and the UK. Both governments offered support. We took advantage of that support where it was available. The net debt was reduced in line with the cash increase. So again, we've come out of this year in a much stronger balance sheet position, and we're well suited to grow the business, whether that be through acquisition, whether that be through taking advantage of competitors in the market who probably didn't fare as well during COVID as we did. So, and the resources that Jason spoke about that we've put into sales and some R&D as well. I think it's important to note that we are historically a strong dividend payer. We pay about 1/3 of our earnings out, net earnings out in dividends annually. We did suspend those like a lot of companies. They remain suspended and did for 2020, but we assume that we'll be a dividend payer again in the first half of 2021. Where we sit today, cash has grown from what you see there. Net debt has reduced further. We anticipate we'll be in a net cash position by Q3, the end of Q3 of this year. So again, strong cash position, strong balance sheet position, reduced headcounts, reduced overheads, and we won't bring, there are certainly large portions of both of those that won't come back because we've learned to operate the business in a more efficient way. So coming out of bio, I think, despite, as I said, despite a decline in revenue, we saw margins increase. We saw an improvement in cash, and overall liquidity, a reduction in net debt. We're well suited to take advantage of the upturn coming in 2021.
Thanks, Brian. I'll briefly mention ESG integration for our business. Our services at their core provide environmental benefits. In fact, for many years, we've provided our customers with environmental impact reports for the last 10, 12 years. Later this year, well, we're starting it now, we're publishing a full ESG overview and reporting platform that will certainly show our business in a favourable light. So summary and outlook, the overarching message is that our industry sector is recovering quickly. We expect it to return fully by the end of this year so we can get back into full growth mode for next year, 2022. Margins have improved and we have the infrastructure now in place to grow the business quickly. The next 2 years is all about sales. The majority of our resources going into driving this. We'll continue to seek acquisitions, but for me, macro is more important than micro. The last year we've been fighting the whole economy with COVID. It's been tough. I think we've done a decent job. Flip side of that, the macro picture's improved significantly with all the money that's been invested in the economy. So we're looking to ride that. And we're pretty excited about the market conditions over the next few years. You can go to our website, filtaplc.com. You'll see you can subscribe to a newsletter there or ask any more questions from that. Other than that, I'm open to answering any questions you may have.
Right, so we've got a number of questions, some quite specific, but I'm going to start with the ESG topic because it obviously is one of the biggest themes that investors are interested in. So presumably, how true is it that your own customers are in fact almost a sales force for your own initiatives, and are less resistant to taking services because they realise the social and environmental impact?
So, we have for years provided environmental impact reports. Not only does it show the customers CO2 savings, pesticide savings for prolonging the life of cooking oil, for example, but we give them a certificate at the end of it. Every report comes with a certificate that they actually display in their kitchen and outside for the customers. So it depends who the customer is. We have universities, love it. Stadiums, love it. Anyone in California loves it. So it depends on where you are and what customer base, but that's one of the big advantages, you're absolutely right, is the environmental side. And we're about to take that to a new level of engaging with our key account customers, because what's important to the customer is important to us. So if their driver is, for example, CO2 savings, we can provide that information to them because all our waste oil goes to biodiesel and offsets diesel. So we're big net savers and we can provide that to customers. Hopefully that answers the question.
Yes, I think it does. So let's start with a question from Stuart. How many of your customers do you know have actually gone bust due to coronavirus and obviously won't therefore be available to take your services in the future?
So in the States, very, very few, because the bigger pictures, the players, the stadiums, the universities aren't going anywhere. They're just taking a long time to open. The smaller places, the restaurants, opened surprisingly quickly. 96% of our restaurant business reopened straight after the first lockdown and have remained open. They were very adaptable over here for takeouts, etc. So the States, very, very little. The UK is a different picture. The UK, we deal luckily with many major chains. That's one of the acquisitions of what Bio, we got that customer base you just saw. McDonald's didn't close any, Tesco's are growing. A lot of that customer base, the big chains are growing. The pub chains are the ones who we're looking at closely. We expect them to close some of their estates, M&B, etc., probably close 25% of their estates. From our end, we tend not to service the smaller places. We tend to be the higher volume units. So I think the answer is wait and see. It's still playing out in the UK, but our customer base really is a lot of the big chains. So we're seeing those being pretty stable throughout.
What percentage of your US customers take every one of your core services, and what are the opportunities for cross-selling products across a wider customer base? Good
question. So in the US, we're very fixed on the fryer management service through the franchise network. We don't have the GRUs over here or SEAL. That's the company-owned business in the UK. Within fryer management, there's several bits. There's a cooking oil filtration, that they all have that. About 90% of those customers we take the waste oil away from. So that's cross-sold, but it's part of the fryer management service. We are, at the moment, bringing the first GRUs over because we just introduced a new grease recovery unit in the UK, which has now been specified by the only unit to be used by McDonald's, Wagamama's, KFC. So in the UK, the new unit is pretty good. It's won awards. We're bringing it over to the US. A long-term plan for us. It's something we're going to be launching to customers here, and it's a different type of market, but we are looking to cross-sell those into that market as well. So hopefully that answers the question a bit. We could always do more of cross-selling. That's one of the big things we've been doing during COVID, and it's one of the big things we've been working on our customers with.
So when you're trying to break into a new customer, what are their main objections to resisting your service at the moment? Is it that they've got another service, or is it a cost-based decision?
Let's take the States and take fryer management. Fryer management over the years is always a very difficult business to start. It's an educational sell. You have a blocked drain, you phone a plumber. No one's out there saying, do you know what, I want someone to come and manage my fryers for me. The industry didn't exist, so we created that. Hard to start with. We overcame that. People understand now you can outsource that to a company. Once we get customers, so that goes forward a step. Once we get customers, we don't lose customers. You keep them forever. And you service them once, twice a week. So, you build a van, you put another van on. That's a franchisee, nice repeat revenue model. As much as our investors like the repeat revenue model for our royalties, our franchisees like the model because once you get a customer, you service them forever. Unless you're an idiot, they become addicted to you, these customers. The objections at the front end are we do it ourselves. We've got a guy that does it ourselves. Now, I would say for the last 10 years, labor's been an issue in the US. We've been pretty much full employment. So one of the big selling points, ironically, is, well, a lot of your staff leave because they got to deal with the fryers. It's hot, sticky, dangerous industry. We take that problem away from them. We thought that would change right now, but there's a big shortage of staff in the US right now. And our biggest barriers to growth is getting good technicians, because I think I mentioned the price of cooking oil has doubled in the last year. So us actually prolonging the life of that oil is one of the biggest benefits we're seeing right now. So we're growing pretty quickly in the US. We have about 70 ads running in different parts for staff. We're growing quite quickly. So we're coming out of this quickly. And so there's various objections, but we train our franchise owners and our sales team on the phones to overcome those objections. We have a very consultative sell, so we go in and we monitor things in the kitchen and get close to them. And we have about a 60% close rate of monitor to job, and then we don't lose the customers.
Okay, so we're going to be running out of time, and there are quite a few more questions, but let's look at the quality of the underlying franchises and the churn. So compare to where you were before we had coronavirus and where you think we'll be in 12 months' time in terms of the size and quality of that. And then the associated question is all about cannibalizing and density of franchises. In other words, oversaturating an area where you're already present as opposed to putting the resources in another area where there's obviously more incremental growth. How do you handle that challenge?
So let me start by saying, if you took a picture, we would like 100 franchisees with 1,000 vans rather than 1,000 franchisees with 1,000 vans. So our whole model is get less franchisees because our growth comes from existing franchise owners expanding. So when we're in a market, let's take Cleveland or take Orlando here, there's 4 territories. Normally we might have 2 franchisees in there with a couple of territories each. The one that's really performing well, we encourage him to buy out the other one because we get quicker growth from that. So most of our growth comes from existing franchise owners expanding. If you took the final 100 you'd want in the US, we have 140 something franchise owners in the US right now. If you took, so you want 100, we probably have about 40 of those guys quality in the network right now. The others we're looking to upgrade over time. So we're always looking for upsells and the opportunity to upsell, especially guys that don't grow too quickly. We look at getting better quality people in there, and we're doing that all the time.
Okay, so I'm afraid we've only got really a chance for one more question, but it's a follow-on from what you've just said. So you're dealing with franchisees who want to expand. That requires extra working capital on their part. How do you help, or do you not help franchisees with that part of the equation?
So they've got quite cash generative businesses, but when they do look to expand, we have a business enhancement loans. We actually provide centrally as well. They can go to the local banks, but we set up a pool of funds, and for that fund, anyone with 3 or more vans, i.e. they've reached a level, they're reliable, they're not going to go out of business. We don't have guys at 3 vans going out of business. Once they've got that level, they have access to the business enhancement loans, which we give them at a, Brian can tell me, 4% interest rate, 8%.
It's the market rate. Yep.
Market rate, and they pay us back. So, but it's easy for them to get. Ask us, we give it to them, and off they go.
Fantastic, gentlemen. Thank you very much indeed. We will now be moving on.
Thank you.
I hope you've all found this afternoon's event helpful. I'd like to thank all of our speakers for their contribution today, and you, the audience, for taking part in the forum. And thank you very much.